Hey everyone, and welcome to This Explainer. Today, we're going to break down the invisible forces that dictate the actual value of the money in your pocket. You know, if you've ever traveled abroad, ordered a product from overseas, or just watched the financial news, you've definitely noticed that currency exchange rates never really stop moving. But what is actually pulling the strings behind those numbers? Well, today, we're going to decode the exact mechanics of currency valuation.
Okay, so let's dive into this. Picture this. Imagine holding three different banknotes. You've got a 100 note of US dollars, a 100 note of Japanese yen, and a 100 note of Kuwaiti dinars. They all literally say 100 right there on the paper, right? And yet, one of those can barely buy you a small snack, another buys a whole week's worth of groceries, and that last one, it's worth more than 300 US dollars. So what gives? Did some countries just wake up and decide their money is magically worth more? Or is there a much deeper, hidden system controlling every single currency on Earth?
To understand exactly why this happens, we have to look at the massive foreign exchange market, commonly known as Forex. This is where a staggering $7 trillion changes hands every single day. Trillion with a T. It's the largest financial market in the entire world. And in this market, the golden rule of supply and demand dictates absolutely everything. So if global companies suddenly need US dollars to buy American products, the demand for the dollar shoots up, and its value goes right up with it. Conversely, if investors lose confidence in a nation, they sell off that currency, and its value absolutely plummets. So here is our roadmap for today's explainer. 1. The illusion of face value. 2. From gold to fiat money. 3. Inflation and interest rates. 4. Trade and government stability. And finally 5. Real-world currency myths. All right, let's jump right into section 1, the illusion of face value. The number printed isn't wealth. The really crucial point to grasp here is that a currency's value only exists when it's compared to another through an exchange rate. It's actually a lot like how languages work. Think about it. English isn't a better or richer language than Urdu, right? It just uses different words to convey the exact same idea. Many people fall for the illusion that a currency's value is determined by the number printed on it. But one US dollar isn't automatically better than one Japanese yen just because the exchange rate happens to be 1 to 160. They are simply measured using a completely different baseline. Moving on to section 2, from gold to fiat money. Building trust in paper. To really get this, we need to look at how money evolved. The shift is just fascinating. We basically moved from a super rigid system tied to shiny metal to what we call fiat money. For a long time, the world used the gold standard. That meant a country couldn't just print money unless they had the actual physical gold sitting in a vault to back it up. It kept things incredibly stable. But as global trade absolutely exploded, keeping enough gold around became pretty much impossible. So by the 1970s, we completely switched to fiat money. Now, modern money is backed by, well, nothing but trust and government decree. If people believe in it, the value holds. If they lose that trust, it crashes. Now for section 3, inflation and interest rates, the internal economic levers. Okay, so since modern money is based purely on supply, demand, and trust, let's look at the two biggest internal forces that pull those levers. First up is inflation. This happens when a country just mindlessly prints money to pay its bills, which causes prices to rise and your purchasing power to plummet. Think of it like this. If you have two countries producing the exact same amount of goods, but one country suddenly prints a billion more banknotes, that money just isn't rare anymore. There are suddenly way more notes chasing the exact same amount of bread or housing. The money loses its value, and foreign investors run for the exits. If you want a real-world example of this, just look at Zimbabwe's tragic hyperinflation. It proves perfectly that printing money without real, actual economic growth completely destroys currency value. Back in the 1980s, the Zimbabwean dollar was actually stronger than the US dollar. But due to economic instability and the government just printing cash to solve their problems, confidence completely collapsed. I mean, people literally needed bags of cash just to go buy a single loaf of bread. It got so incredibly bad that they eventually had to abandon their own money entirely and adopt foreign currencies just to keep the country functioning. The second major lever is interest rates. And surprisingly, central banks can actually use these borrowing costs to make their currency stronger on the global stage. Simply put, interest rates are essentially the price you pay to borrow money or the reward you get for saving it. And central banks are constantly tweaking these rates to try and keep their economy balanced. So how does this actually play out? Well, when central banks raise these rates, foreign investors come flocking in looking for those better returns. Let's say one country offers an 8% return on government bonds, while another is only offering 2%. As a global investor, you obviously want that 8%, right? But here's the catch. To buy those bonds, you first have to exchange your money for that specific country's local currency. This massive influx of buyers absolutely skyrockets the demand for the currency, which, you guessed it, makes it stronger.
Next up, Section 4, Trade and Government Stability. How the global stage dictates value.
Internal levers are great, but a currency's long-term value is heavily dictated by how the rest of the world views it. Investors are incredibly cautious people. They only pour their money, and thus drive up currency demand, into countries that offer true stability and predictable rules. I mean, would you invest billions of your own dollars into a country dealing with political chaos, sudden tax hikes, or rampant corruption? No way. A stable government means consistent rules. Countries like Switzerland have maintained political and economic stability for decades, which makes the Swiss franc a famous safe haven currency that investors run to during times of global panic. Furthermore, trade plays a massive role. Massive exporters naturally strengthen their currency because foreign buyers literally have to purchase that local money to pay for the goods. We saw this exact strategy with China's manufacturing boom. When Japan exports cars or America exports tech, foreign buyers have to get their hands on yen or dollars to make those purchases. This constant, heavy demand keeps the currency highly valued. On the flip side, a country that imports everything is constantly bleeding its own currency out into the world, which puts a lot of downward pressure on its value over time. Finally, let's look at Section 5, Real-World Currency Myths, Debunking the Exchange Rate.
Let's completely shatter some myths here. The most crucial takeaway is that a high-value exchange rate does not automatically mean a country is wealthier or more productive. Take Japan, for example. It is an absolute economic powerhouse, yet $1 equals about 160 yen. That's not because Japan is poor, it's literally just a historical pricing convention. So instead of a coffee costing $3, it costs 450 yen. Same value, different scale. On the flip side, the Kuwaiti Dinar is incredibly expensive, but that's largely due to massive oil revenues and a very small population, not because it has the most diversified, dominant economy on Earth. Real wealth is measured by GDP, productivity, and innovation, not just the raw number printed on the banknote. Now, some smaller nations decide to avoid the whole headache of currency fluctuations entirely by pegging or locking their money to a stronger nation's currency. For instance, Belize simply declares, by law, that 2 Belize dollars will always equal 1 US dollar, and Brunei does this 1-to-1 with the Singapore dollar. It makes trade super easy and gives foreign investors immediate confidence. But the massive downside here, if the US economy takes a hit, Belize takes that exact same hit. They become completely dependent, with their economic fate totally out of their own hands. And this totally interconnected risk is exactly why we don't just use one single world dollar. It sounds convenient, sure, but as we saw with Greece and the Eurozone back in 2009, tying everyone together means one nation's crisis can infect the entire globe. Having a single currency means every single nation has to surrender control of their interest rates and inflation policies to one central bank. If a country thousands of miles away mismanages their debt, suddenly your savings are losing value. Plus, different countries have totally different needs. An importing nation wants a strong currency, while a massive exporting nation might actually prefer a weaker currency to make their goods cheaper for foreign buyers. A one-size-fits-all money just doesn't work. So after uncovering that money is backed by trust, supply, and economic stability rather than shiny gold or some kind of financial magic, I want to leave you with this final thought to ponder. If you had to lock away your life savings for the next 2 decades, what currency would you truly trust? You now know that it isn't about the biggest face value. It's about a nation's long-term stability, their inflation control, and the real strength of their economy. Keep these mechanics in mind the next time you see the exchange rates ticking up and down on the news. Thanks for joining me on this explainer, and keep learning.